Welcome back to the Deep Dive. We're jumping straight into the premium automotive world today, unpacking the Q2 and half-year results for SJS Enterprises Ltd.
Yep, SJS, they're a key player in what they call decorative aesthetics.
Basically, yeah.
Mm.
If it's a high-end, sleek visual feature on a car or appliance, a badge, a trim, maybe a complex plastic part, SJS probably had a hand in it.
That's our focus. We're digging into their earnings presentation, the regulatory filings, and their press release, all dropped on November 3, 2025.
Right.
And this company, look, they're making headlines, not just because they delivered what they're calling record-breaking performance, but they seem to be consistently dramatically outperforming the auto industry itself.
And the timing is perfect for you, the listener, because SJS themselves described this quarter as, well, nothing less than an inflection point. So our mission today is to get beyond just the numbers. We need to figure out the strategic alchemy, right? What drove this massive growth? How are they grabbing market share so fast? And what does their roadmap look like going forward?
Okay, so to understand the jump, we probably need a quick baseline. SJS makes these highly engineered aesthetic bits.
Right.
Everything from decals, premium chrome-plated parts, to 3D luxe badges, aluminum trims, even sophisticated optical plastics. They're basically doing the functional art that makes vehicles and appliances stand out.
And they operate globally and at a serious scale. Give us a sense of that operational footprint.
Oh, they're massive. 4 current production facilities, Bangalore, 2 in Tune, 1 in Manasar.
Okay.
And they've got a 5th, a huge greenfield site, already under construction down at Hauser. Last year, FY25, they served customers in 22 countries, supplied over 197 million individual parts.
Wow. 197 million. That's staggering volume.
It really is.
So that sets the operational scene. Financially, what was the starting point? End of FY25.
They ended FY25 with Rs. 7,605 million in revenue and a pretty strong EBITDA margin too, 26.4%.
Okay. Now, before we hit these huge Q2 numbers, there was an interesting internal thing announced alongside the results, wasn't there?
That's right. Yeah, it speaks to maybe confidence, employee retention, that sort of thing. The board approved allotting 562,000 new equity shares.
Through the ESOP.
Exactly. The Employee Stock Option Plan 2021 naturally increases their total paid-up share capital. The filing gave the details 2 exercise price tranches.
Oh, yes.
Most of them, 542,000 shares at Rs. 263.86, and then a smaller lot, 20,000 shares at Rs. 324.14 per share. It's like a bit of internal bookkeeping just as they're announcing this massive external success.
Okay, let's get to that external success then. Let's dive into these Q2 FY26 consolidated results. The growth rates, they're not just good, they are genuinely exceptional.
They really are, and they back up that inflection point claim. Revenue from operations hit Rs. as 2,417.6 million. That's a solid 25.4% year-over-year growth.
Okay, good start.
But the profitability metrics grew even faster. EBITDA soared to Rs. 728.4 million. That's up 40.9% YoY.
40.9%.
Yeah, hitting a margin of 29.6%. And even after tax, profit after tax, PID, Rs. 432.7 million. That jumped an incredible 48.4% year-over-year.
What's truly kind of mind-blowing here, and what really drives that inflection point idea, is the CEO's comment.
What was that?
They claim their quarterly run rate, just in Q2 FY26, is almost the same as the company's entire annual performance just 4 years back in FY21.
Wow, okay.
Think about that shift. Doing a year's worth of business in, 90 days?
That volume explains why Q2 FY26 is their highest ever consolidated quarterly revenue, EBITDA, and PAT. But the deeper insight for you, the listener, is the operational win.
Which is?
This is their 24th consecutive quarter beating industry production volumes.
24th, so that's 6 solid years.
6 years of consistent outperformance.
How do you maintain that? And what was the specific gap in Q2? How do we know they aren't just riding a market wave, but actively, taking share?
Well, look at the numbers. SJS automotive business grew 29.5% year-over-year in Q2. Now compare that to the overall Indian auto industry, two-wheelers and passenger vehicles combined. That grew just 9.5% UI in the same period.
Right, so SJS grew more than 3 times faster.
Exactly, over 3x the industry growth rate. This isn't just market lift. It shows they're actively winning new contracts, getting their premium components designed in, and frankly, taking business from maybe less advanced competitors.
That's impressive. So let's unpack where this threefold outperformance actually came from. Start with the domestic drivers.
Okay, domestically, the real engine was the two-wheeler segment. That delivered explosive growth, 44.3% year-over-year in Q2.
44%. Okay.
Passenger vehicles were also strong, up 16.5% YoY. So overall, the domestic business expanded 24.0% year-over-year. Solid.
And the export growth seems to signal some aggressive global diversification, right? Exports grew, what, massively?
Hugely. 40.9% year-over-year growth in Q2 FY26. Hit ours 231.9 million.
Okay, so exports are now nearly 10% of revenue.
Yeah, 9.6% of consolidated Q2 revenue, which is good, but they have a much bigger target, don't they?
They do. What is it?
They've set a goal to push that export contribution up to 14, maybe 15% of consolidated revenue by FY28.
15% in, what, 2 years? That seems quite ambitious, especially with global economic headwinds maybe brewing.
It does seem aggressive. It suggests they're not just nurturing existing relationships, but they must be onboarding substantial new OEM accounts internationally, maybe particularly in Asia.
That focus on new high-value contracts leads us right to their core strategy, premiumization, pushing these new-age products.
Exactly.
What exactly are these new-age products, and what kind of impact are they actually having on the revenue mix?
So new age products are the really technologically sophisticated components. Think parts integrated with lighting or motion or even haptics.
So not just Chinese stickers.
Definitely not. We're talking sophisticated stuff. Illuminated badges, high-def optical cover glass for displays, integrated in-mold electronics IME parts which embed circuitry right into plastic surfaces.
Okay, complex stuff.
Very. And these complex products already brought in over 23% of consolidated revenue in just the first half of FY26.
That shift to high-tech is key then, isn't it? Because it changes their whole revenue model per vehicle. You mentioned this idea of kit value. Why is that so critical to their margin story?
Right, the kit value, it's basically the total dollar or rupee value of SJS products supplied for each vehicle or appliance.
Got it.
And their strategy is pretty simple, conceptually at least. Convince the OEMs, the manufacturers, to upgrade from basic parts to these sophisticated new age products.
Which dramatically raises the kit value.
Exactly. And consequently boosts SJS's own profitability per unit sold.
Give us the numbers on that potential kit value increase. That really frames the whole premiumization idea.
Okay, think about the potential margin upside here. In passenger vehicles, they see potential for a 4 to 6 times growth in kit value.
4 to 6 times.
Yes. So moving from supplying maybe RS 1,200 to 1,500 worth of parts per car today, up to potentially RS 3,500 to 5,000 per car.
That's a huge jump.
Oh, it is. For the two-wheeler segment, they're projecting maybe 1.5 to 2x increase. Still significant. And even in smaller markets like consumer durables, they see a 3 to 4x jump possible.
So give an example. How does that happen?
Well, imagine replacing just a simple screen-printed badge with, say, a high-definition, backlit, 3D molded emblem. Or swapping out a basic dashboard cover for an integrated display unit SJS helps make. That single component upgrade is what can drive that sort of 4x potential.
And that drive to massively increase kit value, that's powering what might be their biggest strategic bet right now, the new display segment partnership. Tell us about the MOU with BOE Verotronics.
Yeah, this could be huge, a real game changer. SJS signed a memorandum of understanding with BOE Verotronics. They're a major player out of Hong Kong to manufacture four-wheeler automotive displays right here in India.
And this isn't just like final assembly.
No, it's much deeper. It involves serious technology transfer for complex processes, things like assembly, sure, but also optical bonding.
That's the process that fuses the screen and the glass without air gaps, right?
Uh-huh.
For better viewing.
Precisely. Better clarity, less reflection. And also localizing key components like the cover glass itself and the backlight units.
So this is about tech independence, getting that know-how in-house and maybe import substitution too.
Absolutely. By localizing these complex displays, they're tapping into that huge shift towards digital cockpits in practically all vehicles.
Future-proofing their revenue.
Right. And at the same time, it aligns perfectly with the Indian government's push for more indigenous manufacturing, the Make in India idea.
How's it being formalized?
It's going to be either a technical assistance agreement or potentially a full joint venture, and it ties directly into their capacity expansion plans. Specifically, that new greenfield plant they're building for optical cover glass and this whole display business down in Hosier.
Okay, all these big plans, capacity expansions, tech licensing that takes serious money. Let's look at their financial health. For a company doing this much CapEx, are they piling on debt?
Actually, quite the opposite, and that's really key to why the strategy seems viable. As of September 30th, 2025, SJS reported a really strong net cash position. RTS $1,588.8 million in the bank, net.
So they're funding this growth organically.
Looks like it. Plus, their profitability metrics are exceptionally strong. Consolidated return on capital employed, ROCE, was 33.6%, and return on equity, ROE, was 20.4% in the first half of FY26.
Let's pause on that ROCE number, 33%. Is that high for this kind of company?
For a manufacturing company, which is inherently capital intensive, and especially one that's sinking huge amounts of capital into building new greenfield plants, yes, a 33.6% ROCE is extremely strong.
What does it signal?
It signals excellent capital efficiency. It shows the investments they're making, including hosier, Poon expansions, are already generating very healthy returns, not just draining cash. And critically, they generated strong free cash flow too, ROC $677.7 million in H1. That provides a nice buffer.
Operationally, they're clearly getting nods beyond just the financials. Give us a few quick ESG and operational highlights before we hit the outlook.
Yeah, they're focusing on sustainability. Planning to get renewable energy use up to about 60% of group consumption by the end of FY26. That's up significantly from 38.5%.
Good progress.
They also got certified as a great workplace, won the Hero Value Leader Award, and even individual recognition. Their CFO, Mr. Naridi, was named Leading CFO of the Year for 2024-25 in the auto sector by CII.
Okay, so strong performance, big plans, good financials, industry recognition. With all this going on, what's the forward outlook? Are they expecting things to slow down at all?
Absolutely not. They're maintaining a highly aggressive outlook. They expect to continue this massive outperformance trend, forecasting they'll beat the underlying industry growth rate by over 2.5 times through the full financial year FY26.
And what's really interesting here is the level of visibility they seem to have into hitting those ambitious targets.
It's incredibly high visibility, actually. The materials state that their current order book for FY26 already covers over 90% of their forecasted revenue for the entire year.
90% locked in already.
Yeah. So that removes a lot of the usual guesswork around hitting ambitious growth targets, assuming, of course, they can execute and deliver on those orders.
Okay, let's try and wrap this up.
Right. So to summarize for you, SJS is clearly evolving far beyond just being an aesthetic supplier. They're really becoming a technology integration company for vehicles and appliances. They've hit a major inflection point, achieving FY21's entire annual revenue in just one quarter of FY26. This success seems strategically driven by two main things. First, dramatically hiking that kit value per unit by pushing high-margin new-age products like IME and optical glass.
Okay.
And second, making these massive, apparently self-funded capital investments in new manufacturing capabilities and technology transfer, like that big BOE display MOIT.
So that ambitious organic growth strategy, it really relies heavily on successfully implementing these new complex technologies, doesn't it? Introducing things like optical cover glass displays in mold electronics. These aren't simple upgrades.
No, they're not.
So given this rapid, very aggressive push into highly sophisticated product lines and doing it alongside multiple simultaneous factory expansions, Hosur, Pune, Bangalore, the fundamental question, I think, for any stakeholder watching SJS has to be this. How effectively can they manage all the associated execution risks?
Right. Things like delays, integrating new talent.
Exactly. Managing those risks, especially the complexity, while consistently delivering that incredibly robust margin profile that's now approaching 30%. That ability to manage complexity, that feels like it will define their success over the next couple of years.